Good morning, everyone, or maybe good afternoon, depending on where you're located. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a moment or so. We are expecting a good crowd today, so I want to give everyone a chance to log on before we get started and before the panelists will talk to you about their experiences. For those of you who have logged on, some administrative announcements. You are in mute-only mode, which means that you can hear me, but I can't hear you. If you have questions during the presentation, please type them into the question box on the lower right-hand side of your screen, and we will get to them after the formal parts of the presentation. If you have very specific questions to your situation and you do not want me to read them out loud, please send me an email and we'll take them offline. I expect that we'll probably have more questions than we can answer today. So for those, we will also take those offline, which is why it's important for you to type the questions in so we have a record of them. So with that, I am going to go away here for about a minute, and then we're going to start very shortly. Good morning, everyone. For those of you who have just joined, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main presentation in just a moment. People are still logging on. So for those of you who are on, you are in mute-only mode, which means that you can hear me, but I can't hear you. We have a formal part of the presentation, and after that's done, if you want to ask questions, I'd suggest that you type them into the question box on the lower right-hand side of your screen, and the panelists will get to them. Given the crowd we have today, I don't think we're going to get to all questions, but never fear, we'll take them offline. And if there are questions that you do not want me to read out loud, send me an email, and again, we will take those offline. So I just want to start by thanking the panelists from EA Markets, Kirkland & Ellis, and Prudential Private Capital, who, without their skills and expertise, we'd be talking about the weather, and I don't think that's why you signed in. So with that, I would like to start the main body of our presentation. So I just want to let the panelists introduce themselves. Again, as you see, my name is Bruce Lynn, and I will serve as a moderator for today. So with that, let me just throw this over to the panelists. Ruben, why don't you start?
Thank you, Bruce. Good morning. My name is Ruben Daniels. I'm the founder of EA Markets. We are an independent corporate finance advisor founded during the last financial crisis. Our clients are middle market firms, large public corporates, and private equity sponsors. And we sit on our client side of the table and help them raise capital. And we're really pleased to be here to join this panel. Thank you.
Hi, this is Engen Okaya. Pleasure to be here and speak with you all today. As you can see in my bio, I'm part of Prudential Private Capital, which is the private investment arm of Prudential Financial, the insurance company. We are a middle market lender, investing in everything from large public companies in highly rated senior secured, unsecured loans down the capital spectrum through subordinated debt and minority equity. So happy to provide you with my view of what we're seeing in the market today.
Hi, Judd Oswald. I'm with Kirkland & Ellis. I'm a partner in the debt finance group. My practice is covering financial sponsors and borrowers of all shapes and sizes on their debt financing needs. And, we cover clients from, the largest sponsors down to spin out funds and sponsors that are, one or two person bands. Look forward to speaking with you and hope everyone's doing healthy and safe during these strange times.
Well, thank you very much. And what we're going to do here, just to get started, since this is a little bit like a Broadway play in which the actors are up on stage talking into the dark, what I'd like to do is maybe ask the audience to really sort of identify themselves, at least by their involvement in the loan modification process. And so with that, what I'm going to do here is launch a little poll, and I'm going to ask you if you would vote on this. I'm going to keep the polls open here for about a minute or so, and then I will share this with you so that, again, everybody out there in the dark can see who else is sort of sitting next to them, so to speak. Of course, 6 feet apart, but in the dark, you can never tell. So let's see who's out there. Again, let me give you about another 10 or 15 seconds to see how the voting is coming along. And I can see this dynamically, but I will shut it off in a minute, and then everybody can see what we've got here. So again, a very interesting group. And let me close this off in 3, 2, 1. Thank you for voting. And now I'm going to share the results so people can see. And again, this is for everybody's edification. So it looks like we've got really a lot of borrowers and a lot of advisors that are out there listening. So I'm sure the panelists will be able to talk with you a little bit about how their experiences and the market today could fit your situation. So let's go on here, and we'll move on to the next slide. And these are the questions that really the panelists will be addressing today. A series of questions about really the market and what people are seeing, and then looking at it from a borrower or a lender perspective. And then finally, some suggestions about what could be a best practice in a successful loan modification. So let's just start a little bit about what the market looks like. Again, this is a snapshot, and in this kind of environment, things are changing ever rapidly. If you're a bank, you might not be surprised to learn that banks are expecting a bad day. And so here is a snapshot courtesy of Financial Times from about a couple of days ago. And you can see that for the group below, B of A, Citi, Goldman, Morgan, they are expecting that things aren't going to work well amongst their customers. And you can compare that to the Great Recession. And again, this is just a snapshot, probably out of date even as we speak. But it gives you an idea that the banks are gearing up for some problems, and whether they can talk their customers through them or not remains to be seen. This is another snapshot, courtesy of Bloomberg, for the more creditworthy companies that are starting to draw down on their revolvers. Liquidity now has become a concern. When I first saw this slide, to me, the most amazing part was actually the brown portion of this, in which not only are people drawing down on their existing revolvers, but they are talking with their banks about new loans, obviously with new conditions, and whether there's waivers or modifications. I mean, that's what we're going to talk about. But again, this was April 22nd, so we're about 2 weeks out of date. Switching over to the private equity world, courtesy of PitchBook, gives you a flavor for what PitchBook is saying, looking on the companies in their database. And you can see that if you are a median private equity firm, maybe you're 6 times debt to EBITDA. But if you think about what's going to happen to your cash flow and your EBITDA, all of a sudden now you're up to, well, I don't know, 12, 24. That's unsustainable. And I'm sure that your existing debt probably doesn't consider that. And the interesting thing is when you look at the number of companies that are now owned by private equity firms back in the old days, 2008 versus 2020, twice as many. So if 6% went bankrupt, which they did in 2007 or 8, now all of a sudden the number of companies going into bankruptcy double. So again, it gives you a flavor for the sheer volume and whether the banks are really prepared to deal with that. So at this point, let me just stay here for a moment. I'm sorry. Let me go back here, and I would maybe ask our panel sort of what they have seen in today's market. So if I can start with Ruben, current loan market dynamics. What do you think?
Sure. Thanks, Bruce. The loan market modification started in March, and that was with the initial triage of the hardest hit borrowers. And I think we're transitioning now to address the longer term impact of the economic shutdown. Nearly all companies, even financially well-positioned ones, are facing these loan modification issues. And unfortunately, the market isn't designed to handle the volume of loan modifications that we expect. This is going to put a lot of pressure on everyone's resources, their time, capital, human resources, and there's going to be a lot more competition for those scarce resources as we try to push all of these loan modifications through the second quarter. And I think the implication for sponsors, lenders, and borrowers is that they could be overwhelmed in the next 90 days. And so I think that the key market dynamic from a loan modification perspective is that I think we need to be far more strategic and be more process oriented in getting all of these loan modifications through the system. Again?
Yeah, building on Ruben's point, I mean, we've certainly seen a ton of modification, waiver requests, amendments that are coming through. I mean, I'd say the brunt of it started at 3/31, which just happened to be 2 weeks into this epidemic, and the date on which a lot of principal and interest payments were due. So we certainly had, a flood of activity then trying to figure out whether there were interest deferrals and principal deferrals that needed to transpire, or whether there was enough liquidity in businesses. So I think, from my perspective, from a lender's perspective, the best avenue is, getting out ahead of these, having, direct dialogues with management teams, getting good information, recognizing that there's still not a ton of visibility in the market, but, I think we're certainly trying to be constructive. My sense is all the banks are being constructive. I mean, we're in somewhat uncharted waters and unprecedented times, but this isn't a situation where, a management team or a business made a bad decision. This is really a situation outside of a lot of people's control. So my sense is, the broader lending community is being pretty supportive. Now, there's some challenge situations where funds have back leverage or are funded by public equity, which are proving to be a little bit more challenging. But I think most lenders and firms are trying to get out ahead of this and just having direct dialogues with their clients. Jed, I don't know if you have anything to add to that.
Yeah, no, I agree with all that. I think that's very well said. A few other things I would add, just sort of what we are seeing on the borrower side, particularly in light of, if folks could see me, I would use air quotes, of new financings. There are, I think the markets have stabilized certainly from where they were in March. And one example of that, for those that, like me, look at where the secondary trades of the syndicated loan markets, the March low was loans were trading at around 75 cents discount to par. And as of the end of April, they were up to about 89.87 at a discount to par, where typically those are trading in a healthy market around 98, 97, 98. So, way off where we would like a healthy market, but certainly better from where things were in March. Some other interesting facts are the investment grade market is very robust right now. It's sort of since March, there's been over 500 billion of investment grade paper issued, which is about 84% higher than last year. And another interesting bright spot in the financing markets is the high yield markets. Look, in March, there was about 5 billion of high yield issued, where in April there was 38 billion of high yield issued. So there are some pockets. Also, we're seeing a lot of activity in the convert and pipe space. With the volatility in the equities, folks are looking at convert as an attractive option to put money into companies. So there are some bright spots out there. Bruce, back to you.
Well, thank you very much. It is nice to know that everything is not doom and gloom. Certainly, the market has recovered from its earlier lows. What I'd like to do now is, again, just get a temperature of the audience about what they think is going to happen. So again, I'd ask you to do a little poll here. Keeps the panel obviously talking about those things that are important to everyone on the line. So I would ask if you could vote here about this poll. And so let me launch this one here. And again, I'll give it a few seconds here. About, in your situation, what do you think is going to happen? Obviously, some industries more affected than others, but let's see. So thank you for voting, and hopefully everybody, as they say, votes early and votes often, so we get a good result here. And doing a great job here. Let me give it about another 10 seconds. And 3, 2, 1, and I'm going to shut this off. Oh, we got one more vote in there. Okay, let me just shut this off, and then I want to share this with the group. So you can see here that there's some serious impact that is going to happen here. And I think the other interesting thing is that almost nobody says they will not be impacted. So panel, what do you think? And let me just start with, maybe we start with Judd. What do you think about this poll?
Yeah, I think that it sort of is consistent with what we are seeing. I've described the current situation for borrowers as the tale of two cities. You have companies that were in trouble pre-COVID, and this accelerated their issues. And then you have the companies that were fine, healthy, good, however you want to describe it, that are certainly feeling the impact. And that dichotomy certainly impacts the way borrowers think about approaching their lenders, what they're asking for from their lenders, how cooperative their lenders will be, and will sort of be some of the things we touch on throughout the presentation. Engin, anything to add?
Yeah, I think the data here certainly supports what we're seeing in our portfolio. I don't know that we've done modifications on 56% of our portfolio yet, but it's feeling like it very easily could reach those levels. There are not too many businesses that haven't been impacted in some way. and obviously in significantly varying degrees. I mean, we have some clients in our portfolio that literally went from having revenue one day to barely having any revenue the following day, and those are some challenging situations to try and navigate. So we've seen a pretty large variety of the types of modifications and the severity of them, but I'm struggling to think of any companies within the 1,000+ company portfolio that we have that aren't going to be impacted in some way, be it directly or indirectly from a supply chain aspect, etc. Ruben, I don't know if you have anything to add to that.
No, I think this confirms the thesis that when you have 90% of the companies needing to get some sort of loan modification, and they all need to happen, unlike during the last financial crisis, over 2 to 3 year periods. These need to happen in the next 90 days. I think it confirms this idea that everyone's going to try and squeeze through this very little door all at once, and it's going to be difficult to process all those.
All right, well, I appreciate that. Let's move on now and talk a little bit more specific about what types of modifications the panel has seen with all these years of experience. I'm pretty sure that they have seen many things. So Engin, if I could ask you first, what types of modifications have you seen or maybe expect to see?
Sure. There's a whole basket of them that we're seeing, and new ones are emerging daily. I mean, as I indicated previously, at quarter end, it was a lot of principal and interest deferrals. More recently, as it comes to prime audit release season for private companies especially, we've gotten a number of requests for audit deferrals. Some companies would like to avoid a going concern opinion if they can, and if they see upcoming covenant breaches with their lenders or severe impacts from COVID, they're worried that the auditors are going to provide them going concerns unless they have time to renegotiate covenant packages, etc. I mean, obviously it goes without saying that we're seeing a ton of covenant requests, modification requests, and then more recently we're also dealing with amendments and addressing the need to alter note purchase agreements for companies that have received PPP funding, because in a lot of those instances there may or may not have been baskets that were big enough, or security issues that need to be dealt with regard to government support. So I'm sure there are 10 others that I'm forgetting about, but Judd, maybe you can add to the list.
Yeah, no, I look, I think that's right. I mean, I would say that it's coming in waves, right? So when the things happened in March and folks were scared because no one knew where this was going, most of our time was spent on interest, amortization, any other principal payments, excess cash flow sweeps, immediate liquidity needs. Get through March, then April was really spent on the going concern audited financial issue. And then, in March, most of those were not covenant related, absent, in my example earlier, companies that were already in trouble, because really the effect of COVID and the economic shutdown had yet to run through the financials. So I think right now we are starting to see folks who are starting their process on thinking about June 30. So yeah, I think it's very consistent with what you're seeing. Ruben, anything to add?
Yeah, look, the list of modifications is long. We could probably spend the entire conversation talking about the types of modifications that can and are being made. I think just turning a little bit to some of the larger companies that have been making public disclosures on some of these changes, I think these are illustrative of what types of modifications are getting done. For instance, Marriott got leverage covenant relief through 2021, or Live Nation, which is a name that a lot of folks have been talking about, was even more creative and was able to replace their pre-crisis 2019 EBITDA for their 2020 covenant calculations, as though 2020 hadn't happened, which would be nice. But I think even in investment grade companies, we're seeing in facilities like for Valero, a limitation on use of proceeds to working capital, or in Pioneer, added mandatory prepayment language, which are typically more high yield type modifications. And I think lenders are tightening other constraints like fixed charge and minimum liquidity. We could go on, as they did recently in the Vail Resorts deal. So I think the list of modifications is worthy of its own webinar.
Yeah, I would only add it's been reported in other sources that you even have anti-cash hoarding, and then back to the LIBOR floors, which we haven't seen in a while. So yeah, I think it's changes will be coming fast and furious. All right, let's talk about maybe where people are in the process. Obviously, if you haven't started or if you just finished, your views might be different. So again, I would ask the audience here if they wouldn't mind sort of sharing with the panel where they are in the loan modification process. So let me just launch this poll, and again, we'll give everybody about a minute, and appreciate your honesty. This is for posterity, so if you can answer, that would be great. All right, we have people busy pushing buttons out there. That's great. All right, let me give people a few more seconds here. I want to try to get everybody to vote here. Okay, I'm going to shut this off now in 3, 2, 1. All right, let me close the poll and share the results with the audience. And so then what I would do here is I would just maybe ask the panel about what they think of some of these results. Ruben, do you want to go first?
Yeah, look, I think this is an interesting result. My suspicion is that the no plans have a lot more to do with the advisor participants than they necessarily have to do with actually going through as a borrower or sponsor or lender. So if I look at the breakdown by the first four categories, what strikes me is that, again, this idea that a very small group of companies have gone through the door so far, and what we're left with is the vast majority of those no planners are either in process or starting soon. As Judd was saying, this is a June 30, August 15th type issue, and in order to get through everything that needs to get done, there's an enormous amount of work that needs to happen, and I'm sure those working on these modifications are seeing that and feeling that.
Engen, any thoughts on whether this is helpful to those, especially on the borrowing side?
Yeah, I think it's certainly, I agree with Ruben's analysis in terms of kind of what's constituting the no plans. I think it's certainly, the remaining percentages certainly fit with what we've seen thus far. I think the challenge is just the unknown in terms of how long and how deep we're going to be in this environment. I mean, I can easily see us doing a round of modifications addressing, the severity of the impact, and then, 3, 4, 5, 6 months from now, going back and having to do it all over again, depending on how quickly things come back. So I'd be somewhat surprised at the end of that if we, if the volumes of what we're seeing today haven't doubled or tripled. But I do think at that point in time, hopefully we'll have a little bit more visibility in terms of, kind of knowing how long and how far this is going to last.
Yeah, and this is Judd. One other thing to add, the in process and starting soon, and starting later, I would be curious to know, again, where people are and the size of their companies and sort of information that they've received and how that's flowing through where they think they'll be in June, because obviously, you don't close the books until June, and then you report 45 days later. And so perhaps part of the reason folks are starting soon, starting later is because they're still waiting for the financial information that they need to inform their decisions. And that's one of the things I'll be talking about on the next slide, is how you think about what you're asking for.
Okay, so let's move on here. Let me just take this down, and then we're going to go on to the next panel question about what the borrowers need. So we want to take this from two perspectives. So let's start with the borrowers first, and Judd, if I could ask you about what borrowers should be sort of looking for.
Yeah, sure. So like I said, I'm from Kirkland & Ellis, and apparently there's a reputation that we are aggressive in the marketplace. So if folks don't think I'm being aggressive enough in what I'm about to say, please let me know. But look, I think it is the advice we've been giving folks is sort of be careful what you ask for. Every lender, whether it's a syndicated loan or a direct lender, is dealing with issues. And so this is a time where folks should be very thoughtful when they are approaching their lenders. We are making sure that folks try to understand the sensitivities that with which their lenders are dealing. I had a situation in March where the sponsor called up its lender and said, hey, this was, like I said, it was in March. We have an amortization payment due the 1st of May. Can we talk about, a waiver of amortization? And the response was, I got guys who aren't paying interest on Monday. I don't have time to deal with that's a tomorrow problem. So I think it is, before you approach your lenders, understanding, okay, am I in a syndicated deal or am I in a direct lender deal? And that should inform, sort of your approach. I think that what's really important is information. Folks need to be going to their lenders and having good information so that they can, the lenders can react quickly and you do their homework for them. Too many times folks approach their lenders and say, hey, I need a covenant holiday. And the lender says, okay, do you have a forecast? And the answer is no, right? Having that information prepared that they can digest, having it on, reasonable assumptions. We had a situation recently where, where a borrower is going out to ask for covenant relief. And when we were talking about how they would present their financials, we're saying, okay, look, put where you're going to be for the year, and then let's have a separate bucket of items, what we'll call, COVID-related items, so they can see, okay, here's one-time costs that the business is now occurring that previously didn't run through the forecast. Here's lost revenue that that's a direct result of that. And, here's what we refer to as sort of the uncaptured costs, not my profit, but what was my cost of goods sold that I would have otherwise recaptured. And so that when they approach their lenders, they can very clearly see, oh, here's the real economic impact. And then the next thing is approaching and asking for what you need, not necessarily what you want. Had a situation yesterday where a borrower said to me, hey, I really need it for Q2, but I'd like it for Q3, and Q4 would be even better. And, we said, okay, that's fine. But you need to think about, when you ask for that, what the lenders are going to say in response. It's a lot easier to get your lenders to agree to a one-time covenant amendment versus 3. the longer it goes out, the more you ask for, you should expect the banks and the lenders to be asking for more in return. Bruce mentioned cash hoarding. This is very common. You know, folks that drew down on their revolvers that are sitting on cash, now they turn around and ask their lenders for some sort of relief. The lenders are saying, sure, but now you have to pay me back, pay back my revolver. Let's get some cash off the business and into our hands. Separately, we're seeing liquidity covenants. You know, folks saying, okay, fine, I'll remove your financial covenant, or I'll give you a waiver or amendment, but I expect in the same period for there to be some sort of minimum liquidity. We need to monitor the business. For private business and sponsor businesses, the first question you're going to be asked is, are the owners ready to put in money? You know, what are the owners willing to do to help share in the pain here? Particularly, again, when you have situations where folks are sitting on a lot of cash and asking for relief, it's hard to convince the banks that they should be the sole ones bearing the pain. And then again, Bruce mentioned LIBOR floors. Absolutely, press up and step ups in pricing, shutdown of baskets, and flexibility. And so again, as you're thinking about what you would like versus what you want, it's really important to think about what kind of reaction you're going to elicit from the banks. And the last thing I would say, at the risk of a plug for the lawyers, make sure that you're talking with your lawyers in advance so that you're asking for things that are actually achievable. You know, for example, if you have a syndicated deal and you're asking for interest relief, that's not the easiest thing to pull off, particularly if you're going to them at the last minute. You know, certain amendments to documents take more time than others. So I also think that in part of that preparation and putting together the financial information, it's also speaking to your lenders and any other advisors so you have a full picture of what's achievable. Engin, how about any thoughts there? I know you're on the lender side.
Yeah, so just two things to add. I mean, you alluded to this, Judd. I mean, I think one is just, you know, make sure you know who's in your lender group, you know, ulterior motives, you know, reputations, et cetera. I mean, you know, there are firms out there that are definitely more of the loan to own mentality, you know, which they have very different objectives than, you know, a traditional bank would. So I think it's pretty important to understand kind of the dynamics, especially if you have a layered capital structure. You have senior lenders or second lien lenders, subordinated debt lenders. I mean, they all, you know, at the end of the day have return expectations in mind, but they also are incentivized sometimes to act in different manners. So I think that's something that's pretty important to know. You know, emphasizing what Judd said, giving us as much information as you can in the most transparent and, you know, constructive manner, obviously buys a lot of goodwill. I mean, I think we of course appreciate and recognize the fact that there's not a ton of visibility right now. So, you know, projections that you may deliver us or reforecast are, you know, undoubtedly going to be wrong. But the fact that you're willing to provide information and be constructive and have weekly calls and provide 13-week cash flow forecasts, I mean, that does buy a lot of goodwill. I mean, the other thing that I'll mention, I mean, this works against lenders to a certain extent, but I think it's important is, you know, make sure you're achieving the appropriate amount of covenant headroom. I mean, especially if you're, you know, going to your lenders and, you know, offering some price concessions or other concessions, you know, make sure that you don't set yourself up in a situation that you're going to have to revisit all this, you know, the next time your quarterly results come out. I think at least from our perspective, we're trying to be pretty constructive and give folks the right amount of headroom if, you know, if everyone's acting in a constructive and appropriate manner. But the last thing you want to do is go through all this and then have to go through it again in the near future. So Ruben, I don't know if you have anything else to add to that.
No, I think you guys covered a lot of it. I think I want to reinforce the idea that I think both you and Judd were talking about, which is something often overlooked by borrowers, which is to understand their lender's motivations, to put themselves into their lender's shoes, the capital position, the portfolio performance, Are they collaborative or adversarial in their approach? I think that's extremely important. As Judd was saying about, himself, about Kirkland, I think it is important to be thoughtful when approaching lenders. Our job is to protect our clients. And I think we've been surprised in a lot of the loan modifications conversations that we've been having, in that sometimes, or more often today, doesn't mean asking for everything we want. I think borrowers need to know what they're going to need to get through this period, what modifications they want, what they're prepared to concede, their overall negotiating position, and frankly, even alternatives that are available to them. Examples could be for different capital sources, an asset financing, an ABL, a mezz or junior debt, or even an alternative lender group. But being able to understand both what the borrower needs and what the lender needs, I think, is essential for borrowers going forward.
I would just only add, I would add a little operational 2 cents there. I think it's been said by both Judd and also by Engin that companies need to step up and have a good forecast, and not just do this in what I'll call accounting time at the end of the month, but be able to do rolling forecasts and stay in communication with their lenders so that there are no surprises. I'm always surprised when I go inside companies and take a look at their cash forecasting processes, and they're really just a disparate set of spreadsheets that really don't give anyone a good sense of global visibility. And if you can't use your own cash well, then why would you want your borrower to, or your lender to lend you more? So there is a premium to be put on your own internal operations when it comes to cash forecasting. Let's move to the next question that we want to address, and that is really looking at, from a lender's perspective, what do lenders really look at? We talked a little bit from the borrower side. Now I want to switch that around, and as a lender on the panel, I would ask Engin maybe to share some of her knowledge with the audience.
I think I alluded to this a little bit in my prior remarks, but the most important thing is just having direct lines of communication, transparency, good information, etc. I mean, knowing as much as we can about the situation that our clients face obviously helps us to the greatest extent we can set up a construct that's going to work for the company moving forward. So I'd say that's kind of the most important aspect of it. I mean, the other aspect of it, again, in a layered capital structure, is participation by everyone and kind of shared pain, shared gain. I mean, there are situations that we're in where there's a senior lender, we might be the mezzanine lender or junior capital, there's an equity fund in place, etc. I mean, coming up with a proposal where everyone is contributing to the necessary liquidity situation and or construct becomes important. We're certainly willing to participate and contribute our fair share, but situations where, private equity funds may not be as willing, or the senior lenders are being stubborn for whatever reason, if we're sitting in a junior capital position, just don't set the company up very well for success either. So I think trying to coordinate your lending group and convince everyone to coalesce around a proposal that kind of shares the burden. And look, I mean, it might mean that the management team needs to contribute in some capacity, or, there may be earnout notes that need to be restructured. I mean, there are many ways to do it, but I think coming up with a proposal that meets everyone's needs and has everyone contribute in some fashion is pretty important in this environment. Judd, I don't know if you've seen anything else from the documentation standpoint in that regard.
Yeah, no, I think that's all right. It comes back to, one, I mean, a lot of these situations are very bespoke, right? And so depending on the situation of the borrower, it's going to inform, what lenders are going to ask for from the borrower. If you have, example that I mentioned earlier where the company said, look, we're great, we definitely need something for Q2. We love Q3 and Q4. Sort of the discussion around was, okay, well, what are you willing to give up for Q3 and Q4? And we sort of discussed the various puts and takes that would likely be required. And, to Engin's point about, sharing in the pain, it's a lot easier to convince the lenders, hey, I'm not going to put in equity when I'm only asking for one holiday of quarter of covenant relief. And also, again, if you're in a situation where, hey, you're not going to put in equity, which look, that we have plenty of clients that are saying, look, I'm not putting additional equity into this situation, then folks just need to be prepared that that's going to take a different flavor of negotiation than it otherwise would. Neither right or wrong. There's no good, everything's different, right? But it just, folks are looking for some sort of, to Engin's point, participation by folks.
Yeah, I think look, first and foremost, lenders obviously need to protect their investment. And what we find ourselves advising our borrower clients is the next most important thing to bring to a lender is a path to a successful outcome. Incorporating all the things that Judd was talking about, incorporating what Engin's motivations are, visibility on the business and financials, signs of shared commitment, and proposals that meet everyone's objectives. This is a time where if the volumes really come together as we expect, this is a time where showing a path to a successful outcome is going to be recognized and appreciated by everyone involved because they have lots of things to handle.
All right, well, let's talk a little bit more about what people are thinking about when we talk about modifications. And we do have our last poll here, which I want to launch. And in this case, we're just talking about really the term of a modification. Can't get into the real nitty-gritty of a 500-page loan document. But the idea that if you're talking about terms, what kind of term loan would you be looking at a loan modification? Or maybe you don't need a modification at all. But if the audience would take a look at some of these answers, and again, appreciate you, everybody voting. And then we'll turn it over to the panel and see whether this is a surprise or maybe par for the course. Okay, a few more seconds. And shut it off here in 3, 2, 1. Thank you very much. And let's go share this with the panel. And again, let me start, Ruben, let me start with you. Do these results surprise you?
A little bit. I would have expected to see more of a kick the can forward desire from companies. And I think the 12-month and longer is certainly aspirational, not impossible, but certainly the modifications we've seen publicly disclosed have been less than 12 months, 364-day and shorter, or through the end of the year, or as Judd was describing, or as Engin was describing, short-term deferrals. I think the inclination of lenders is, particularly the big banks, is to offer a much shorter loan modification that gets us more visibility and gets us through September. I think it's aspirational and certainly appropriate to go longer than that, but the result or the impact of that is those are much more challenging conversations to have. And the more challenging conversations you have, the more time consuming they are, and time is one of those resources that I think the system doesn't have a lot of. Judd or
Any
Andy?
thoughts on?
Yeah, this is Judd. I mean, the one thing I would add to that is I bet if you did this poll in July, when folks have more information, that the 12 months and longer than 12 months would be higher, because folks would have more information upon which to forecast and be able to then figure out, okay, what do I need? Or I guess in theory, it could also have the opposite effect. You might have better information, and so you won't maybe you will need less time. So it only proves the point. Nobody knows what's going on here.
Mm-hmm.
Yeah, I was going to say, it seems to me people are maybe somewhat optimistic because a lot of the modifications that we're doing are going into next year, just because, if you look at a kind of rolling 12-month impact on businesses. So I actually took the answers to be somewhat optimistic in the sense that maybe people don't think that this is going to have as much impact on their business as they thought. But the way we look at it from a lending perspective is, if you have LTM, EBITDA covenants, coverage covenants, et cetera, I mean, it takes a while for this to work its way through your financials and your numbers. So most of the modifications that we're providing are actually longer term in nature, just because they almost have to be.
Okay, well, I appreciate that. Let's move on to, I think, the final question that I want to address to the panel, and this is really the question about sort of where do we go from here? Talked about different perspectives, but at the end of the day, you've got to get something done. So, are there some sort of best practices, or what kind of processes should either borrower or lender accept to get to good? And with that, maybe Ruben, we'll start with you first.
Sure. I'll go first on this one. I think from our perspective, the two key processes for a successful loan modification are preparation and implementation. And I think we've talked about all of these throughout the discussion today, but to put some context around it, preparation includes the financials, alternatives, and roadmaps, preparing the models, the forecasts and scenarios, looking at different modification and concession proposals, different capital sources, developing communication, proposal, and execution plans. That preparation process that I think many companies are going through right now is, I think, the first key process. And the second is implementation. And I think implementation breaks up into three pieces as well. There's a negotiation element, a documentation, and an execution element. And from a negotiation perspective, this is really the commercial discussions, both direct and indirect, with the lenders and the other key parties in the transaction. On the documentation side, it's the structuring and preparation of the agreements. I'm sure Judd will say the words matter, and I think that's a crucial part of this exercise. And then finally is the execution, the distribution of the agreement, the allocation, and ultimately the successful closing of the transaction within the time constraints that we have in front of us. I think those are the key framework we use around successful loan modifications. Judd?
Yeah, I agree with all that. I mean, I'll give a success story of what I thought was one situation we did for a company about a month ago that got out ahead of this. And, we put together a really good, concise list of what we wanted. The sponsor was prepared to put in equity. We sort of looked at the documents and worked with the sponsor to say, okay, here's what we could do. The sponsor is going to put in X dollars. Here's what we could do. And if we wanted to take the money back out, we could, right? So we could put it in we set up a game plan and said, here's what we could do. Here's the information, and here's what we want. And we approached the lenders. We gave them enough time to digest it. And we said, look, in lieu of what we could do, we're going to suggest we do this with you. And the lender really appreciated it. It was very open, very transparent. We got the result we wanted. It was very collaborative. The lender appreciated that when we went to them at first blush, we were sort of offering up to put in some equity. And, the advice I told the sponsor before, I said, you are going to be shocked at the amount of goodwill you will build by offering to put up some equity to help bridge the situation. Because again, there's no right or wrong, but there's just a lot of folks that aren't willing to do that in the current situation, which is fine. But I think being willing to sort of suffer in some of this and putting forth a good proposal of what you actually need, the lender reacted quickly. They were very pleased with it. We ended up getting amortization interest waived for the balance of the year, plus we got covenant relief. So it was one of those things where we asked for a lot, but we put up a lot to get a lot, and it was successful. And so, but for the approach, but for the willingness to put in money, but for some of the other document restrictions and freedoms that we gave up in order to achieve that, I'm sure we wouldn't have been as successful. But it was a really good process. And I've got plenty of other situations that are not going like that. And they're much more sort of in the trenches negotiations where folks are being difficult. But again, everyone has their own motivations, neither right or wrong, but that's one where it was pretty seamless. Engen, what about you?
Yeah, I'll echo everything you said, Judd, and at the risk of sounding like a broken record, go back to my kind of transparency, information, collaboration points. I mean, I think the story that you just outlined encompasses all of those. I mean, the one thing lenders don't like are big surprises. So even if you see something coming down the path that isn't positive, we'd rather know about it sooner rather than later. And obviously are more willing to be more flexible, if others are sharing in the challenges and the situation. So I think everything you said is completely spot on.
Yeah, and sorry to jump in. It just reminded me one other thought. Again, going back to what I said as a borrower, obviously taking the temperature and being cognizant of whether you're in a syndicated loan versus a direct loan informs some of this. Certainly not advocating in the case of a syndicated loan with public debt, blasting to the world your current financial situation. Again, you've got to be thoughtful about your situation. The direct lending market, a single lender deal, a club deal with relationship banks, that certainly affords you the ability to be a bit more transparent upfront versus what is often, in the case of a syndicated deal, a sort of a staged approach based on timing and what you're trying to achieve. Sorry, I didn't mean to jump in, but wanted to make sure I made that point.
No, not at all. It's a good one.
Okay, well, I thank the panel here. We're reaching sort of the magic 1 hour mark. Now, we do have, as you might suspect, we have many, many questions. And in fact, we've got enough questions here to stay on the phone for another hour. But I also realize is that people do want to go back to work. So at this point, we have concluded the formal part of our presentation. And we still have many people on the line, many questions. But if you do want to leave, I understand. This session is being recorded, so those of you who do leave, at least you can hear the Q&A after the fact. And hopefully the panel does have a little bit more time, but I probably will have to shut this off before answering everyone's questions. So let me do this and flash up the panel contact information so that if you want to reach out specifically to any of the panelists, email addresses are below. And I'm going to leave this slide up here, and let's go through some of the questions. So here's a question that I would address to the panel. It was said secondary market loan pricing has improved from the lows. Has there been a notable increase in volume of secondary market loan trading? I think, Ruben, I might want to give that one to you.
Sure. It's hard to compare secondary market loan volume trading with last month, where volumes were extraordinarily high. I would describe secondary volume trading as lower than last month, but consistent with the new issue market, very active. And I think you've seen that in the secondary trading results for the banks and those that have reported. What a crisis like this or an economic shutdown like this does is force people at all levels to think about where they're invested and what the character of their investment portfolio looks like and how to protect that portfolio. And I would expect there to be continued sustained secondary market activity as the financial products move from those that perhaps have too much to those that have too little.
Yeah, and the other thing I would add to that is, remember, in the syndicated market, the CLO market is very robust and is a big mover of paper. And with a lot of the companies starting to struggle, with a lot of the companies getting downgraded, with a lot of the companies publishing financial results, a lot of those CLOs can only hold so much of lower quality paper, and so they're forced to sell it into the market, oftentimes at a deep discount.
Here's another question. I'm sorry, go ahead.
Oh, no, I was just kicking it back to you. Excuse me.
Okay, thanks. Here's a question, which I think actually, Judd, you may be the person to at least start the conversation. The question is, would you suggest to negotiate with all the lenders together and let one know about the negotiations in course with the others, or to have the negotiations occur separately?
So that's a great question, and at the risk of being a lawyer, I'll say it depends. If you have as the borrower, right, take a step back, as the borrower, we always want to control the information flow, right? We want to, someone once used the phrase, we want to control the cadence of the discussion. And so the larger your syndicate, the more difficult it is to control that cadence. We're worried about leaks, we're worried about, all sorts of issues. And so, if you've got a club deal, if you've got a small club deal, frankly, in a lot of cases, as long as you're being transparent with everybody, I'm not sure it matters who you start with. Typically, you might want to start with someone with whom you have a better relationship. You might want to start with somebody who controls a large share, who may have influence over the other ones. If you are in a large syndicated deal, yeah, I mean, you by definition have to start with some and then stage it with others. We had a situation in March, widely syndicated term loan, privately held second lien. We went to our second lien first, who was a relationship private lender, outlined what we wanted to do. That second lien happened to have a decent sized piece in the first lien. So the second lien was on board. They sort of knew what was going on. We then went to our agent bank, who we had a good relationship with, and said, here's what we're thinking. Here's how we want to stage this. Because there was no real major holders in the 1L, we sort of approached everybody at the same time. We felt that the group was small enough, albeit widely syndicated, and we were only asking for a majority vote, that by holding a lender call, walking through everybody simultaneously, and asking for a quick turnaround on what we wanted. And again, we went to the market with the right puts and takes. It worked out well. We got a great result. It was fine. I have other situations where the company's in trouble. We have a small group of lenders that hold not a majority, but a decent amount. And so in those situations, we're dialoguing with them. So it is one of those questions that really depends on the dynamics of the company, the lender group, how widely held it is, and sort of how troubled the borrower is. If you're really troubled and every day counts, you certainly want to be very critical, because you don't want vendor or trade to dry up if there are leaks. So hope that's helpful.
Yeah, I mean, I would reinforce the it depends answer. I mean, there's so many different elements to that question, and I agree with Judd that controlling information flow is critically important. And I think along with that, there are many different ways to communicate with your lender group. You can communicate directly, you can communicate indirectly, you can communicate through the lead, you can communicate through the group, you can communicate in countless different ways to achieve your objectives. And we were working on a transaction recently where the lead was not particularly supportive of the changes that the company wanted to make. And so we reassessed and actually went to the other members of the lead group and built consensus so that we knew we had the modification and the votes required for the modification in our pockets. And by doing so, we were able to persuade the lead to participate, even though their original stance was, well, we would do it, but we know the rest of the syndicate won't. So I think the core element of the answer here is there are lots of different ways to communicate, and it's not just always direct to the top.
Let me go with another question here. And again, I apologize. We're not going to get to all of the questions. And I know the panel has been very good with their time. And we are sort of about 6 or 7 minutes over our allotted time. But I have maybe 1 or 2 more questions, if that's okay with the panel. And here's a question which maybe I would direct to Engin. Under what situations have you rejected loan modifications?
I'd say the biggest area that, we've probably had troubles with are, the scenarios where someone's coming to us, asking for significant covenant relief or the like, but not really agreeing to contribute anything or support the business in other ways. So that could be a private equity fund, that could be a family, for example, that owns a business and has taken significant distributions over the years. I mean, if they're not willing to support the business and potentially provide some incremental liquidity, but are asking the senior lenders or the subordinators lenders to do so, I mean, that just doesn't kind of feel right. Again, it goes back to my premise of, there's a challenge and it should be the entire capital structure's responsibility to fix it, not leave, one group holding the bag. So, I'd say reject in the context of we probably had further negotiations. Or, we could decide just to not provide a modification and operate in default if, it's really an egregious ask. But I'd say most of the times we're coming to some type of an agreement. Maybe it's a protracted negotiation, but again, to get to something that seems fair and equal with everyone contributing to the solution.
Yeah, the only from the borrower side, I think I have one example where we couldn't get anything done, but it did require, the company was running out of money, and so it did require a capital injection. And the lenders said, look, we're not going to put up any more money, and we're happy to own this company. And so you borrower, you sponsor need to figure out how you're going to fund this situation. It was one of those companies I described that was already in trouble, and it was just exacerbated by the shutdown. And so that's part of the reason that folks were unwilling to put additional equity in. And so now we are sort of in the throes of a value transfer.
Let me make this the last question here, because I know we are running a little late, and I never want to get between people and their lunchtime. Question, what covenants are being negotiated currently in this climate? Is there a most popular covenant, debt to EBITDA, interest coverage? What do the panelists see? And Ruben, maybe I could ask you to start.
Well, I think as the panel has said already, the deferral of interest and principal, particularly for the middle market companies, is clearly the first one and probably the most volume driven at this point. I think where the other nuances of the agreements are going to start to be interesting is going into the end of the second quarter and really understanding where the pressure points are. I'm not convinced that that leverage is the only waiver that companies are going to need. I think particularly in the non-investment grade space, middle market space, restricted payments, baskets, the limitation on liens, those types of operational components to the facility are going to be where the biggest pressure points are going to be. And I think those companies that have been really thoughtful and programmatic in how they've expanded those baskets are going to be in a materially better position than those that have just said, okay, you know, lender, give me what you got, and you know, we'll figure it out later. So I think we're going to open up and spend a lot more time from a credit agreement perspective on those what I would describe as more nuanced components of the credit agreements than we have in the past.
I'd say from a financial covenant perspective, what we're seeing the most is kind of a hibernation of traditional financial covenants, so fixed charge, coverage ratios, leverage, etc., and a move more toward liquidity or minimum EBITDA. I mean, you could set a 20 times leverage covenant in your agreement, but it doesn't really matter if you can't control your EBITDA and you have your debt options pretty buttoned up anyways. So I'd say in a number of instances, we've just suspended those types of covenants, but implemented a minimum liquidity covenant, because that's what everyone's really concerned with at the end of the day, is making sure that the company has, adequate capital for working capital, payroll, etc. So that's not something that, we'd agree to for the remainder of a agreement, but, as I mentioned before, kind of working through this 12-month period when you have, pretty depressed EBITDA that's impacting your financial covenants. That's been important to us, or, literally just implementing a minimum EBITDA, but dropping it to a pretty low level, just to make sure, if things really go, really turn even further downturn, that we'll be back in voice before, things are very dire.
Yeah, this is Judd. That's all consistent with what we're seeing. And then the only other wrinkle I would add in terms of negotiating the financial covenants is there's a lot of focus on, okay, once my covenants come back online, whether that's Q1, Q2 of 2021, how are we thinking about EBITDA on an LTM basis, particularly those quarters that will still feel the impact of the downturn, right? So I don't want to reset my covenants at a level for Q1, but because I still have Q2, Q3 from 2020, which were the down quarters, where I'm in a situation where I, trip the covenant again. So, whether it's, I think, Ruben gave the example of using 2019 EBITDA in one case. We've seen other ones where folks will just start annualizing new quarters. We've seen other folks who just, create a plug number for deemed EBITDA, say, okay, for Q2, it'll be X, for Q3. So there's a number of ways to get there, but that's also part of the discussion.
Well, I thank the panel. We are, again, past our date and past the hour. So I want to thank the panel for all of their help. Again, we have more questions here than we could answer, but I've got them all captured, and we'll address them to the panel and hopefully take them offline. So with that, I would thank the audience. Thank you, panel, for contributing your time. Again, this is a very fluid situation, so maybe we should, think about meeting again and seeing where we are. So with that, I would like to end the webinar.
Thank you.
Thank you.
Thank you.
Thank you. Thanks to everyone.